So in the last video we discussed about repo market, which is the primary source of borrowing for commercial banks. But in this video I'm going to talk about a metric and the monetary policy of the central bank, in which central bank can hold a proportion of banks' deposits in form of cash, and that's cash reserve ratio. Well, let me take you down to what is CRR. It's cash reserve ratio. It's the minimum amount a central bank can impose on the commercial banks to maintain that as a reserve. Now, I'm not talking about fractional reserve here, which we discussed in the first video. Well, if you're a little bit confused about fractional reserve, I'm going to put a link to the video here. You can check it out. But we were talking about cash reserve ratio. The purpose of cash reserve ratio is to be only touched when there is an emergency time or a crisis, you can say, because banks have deposited and taken out a percentage of their NDTLs, that's net demand and time liabilities. We'll discuss it in the next video, but we have to make a target. But by the end of this video, we're going to be very cleared about two things. One is importance of CRR. The second one is how are the numbers calculated by promoting and by pumping the liquidity of this whole economy. Now, number one is importance. Now, as we all are very, very well aware about the fact that banks usually allows customers to open up their accounts for lending activities because they need to make a huge spread out of it. Now, spread is a difference between borrowing and lending rates, but the main purpose is still intact: to lend out maximum amount of money from the bank, or in simple words saying, to get the money out of the bank as soon as possible, because they need to make interest income out of it from loans, advances, etc. Because maximum lending usually help banks to achieve high profit margins, high profitability. But let's suppose if there is a situation where there is a sudden increase in withdrawals by depositors, so now what happens? The banks will not be able to pay all depositors comfortably, and that's where cash reserve comes into the picture, where they can actually access those funds which are liquid cash, which is kept by the central bank, and may be able to distribute all to the depositors. And that's why cash reserve ratio, I personally consider that as a force with a high momentum, which is acting like a sudden supply of cash and credit in the nation's economy. And we as consumers, we can rely on these reserves way better than having a national stabilization scheme. But there's only one drawback in this situation, and that's if the cash reserve ratio is very high, then the lending rates will automatically get decreased. Because if the central bank is demanding more deposits, more percentage of deposits from the commercial bank, then the money supply of the bank will get disturbed. But as we all know that in any situation there is a pro, there is a con. In this situation, the pro is that banks can save themselves in an emergency time. The con is that banks will not be able to lend more money with high interest over a period of time. But there's a wonderful advantage. Let me explain you in a very, very simple way. Here are the total deposits of the bank. If the lending rate is getting increased, then the cash reserve ratio is getting decreased. If the cash reserve ratio is getting increased, then the lending rates will automatically have to get decreased. And that's where the big picture comes. The big picture is in terms of high inflation or crunch in the growth of the economy, or in a crash, when government needs to pump up the system with funds, they conveys the RBI, the central bank, to lower the cash reserve ratio in order for them to lend out maximum amount of money. And that's the beauty of this picture. Now, the second objective is to perform calculations in order for this whole cash reserve system to be monitored. So let's get to it. Now let's say a bank is having a NDTL, net demand and time liabilities, of 100 million. Now, demand liabilities and time liabilities are two different concepts. In demand liabilities, it comprises of savings account, current accounts, bank guarantees, lines of credits. In time liabilities, we can constitute fixed deposits, recurring deposits, etc., etc. Now, when a bank is having an NDTL of 100 million, today the current cash reserve ratio is 3%. That's 3 million that needs to be stored by the central bank. Now, that bank has to maintain 3% in reserves. Now, let's suppose if that bank is reporting 2 million on the sheet, now that's 1 million of shortfall. Now there's a penalty involved which has to be paid back by the bank. Within the first day of default, bank has to pay 4.65%, which is the bank rate, plus 3% on that shortfall. And as the days are going on and banks are still not paying to the central bank, then the penalty will be 4.65%, which is the bank rate, plus 5% on all consecutive days. And that's why banks need to maintain that reserve daily. So you understand how a beautiful reserve saves a bank in an emergency time and provides appropriate liquidity among all the sheets. So it's time for me to sign off, but in a couple of days I'll be coming up with a new video and there'll be more of finance in your mind. Till then, stay tuned to my channel, be safe, God bless.